Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking rates and 10-year note yields. Finding a little bit of a home in this 285, 287 area. It looks to settle for the fifth consecutive week in that area, in that span. And to me, it just suggests that the market continues to wait for some scenario, some catalyst to push it. We failed to get to 3% again this week, despite the fact that stocks sold off pretty heavily, despite the fact that we had a Fed Chair Powell speak and we had talk of tariffs and economic data on all fronts. We failed again to see 10-year notes rise. We actually saw them sell off not only after Powell spoke on Thursday, but also with talk of tariffs coming and uncertainty there as well. So market volatility in lieu of all this remains elevated. We had anticipated that after Powell spoke, we would have seen lower volatility, given he was kind of the wild card in this whole week before we knew about President Trump's tariff announcement. And he was the one that was going to kind of bring a little bit of calm. We would get his scenarios, get his what ifs here. What happens if the market does this? How will the Fed react? But we really got more questions than answers. And yes, the Fed is on path to gradually increase rates, 3 rate hikes, possibly 4. I think that's the one wild card the market is unsure about. But we're starting to see some slightly negative economic data. So right now, volatility remains elevated because uncertainties remain elevated. And we're in kind of a period where yields are very near that 3% threshold, which could change everything. Likewise, if we see any more weak data, we see some uncertainty, yields could go back lower in a flight to quality bid. So there's definitely a tug of war going on, and we're sitting right in the middle. And as we enter into next week, in the post Powell testimony, post President Trump tariff announcements, which has sort of sent ripples through the market, we have employment. Employment will come Friday the 9th. And obviously, this employment has been a beacon of hope on all fronts for not only the president, but for the economy and for the markets. So we will look for that to continue. However, the big moment will be not until the March FOMC, which doesn't come for a few weeks after that. And that will be really the moment where the market decides whether it's going to go back to lower yields or it's going to ascend to 3%. We may get there next week on employment, but I think ultimately for a sustainable period, we have to get through March FOMC. That will be the it moment for the market in the month of March. Likewise, volatility should remain elevated until we get there with moments of declines. But I think ultimately this market wants some clarity from the Fed. It wants clarity from the data. And it wants to really know what's going to happen in lieu of all these tariffs. There's been some comparisons to the 2002 Bush tariff hikes. This is really nothing like it. We saw stocks sell off, the dollar sell off, we saw treasuries rally. But ultimately, those were huge moves, and we're not seeing that, at least not this week. And I think they're probably, the comparisons will continue to be made. However, let's wait and get through next week and see if there's any real reality trade to that. So right now, treasuries hovering in that same range we've been talking about over the last month, heading into employment next week. This is Todd Colvin coming to you from the floor of the CME Group.